If you look at a lot of the major indexes, they're flatlining to down really since late last year. The actual peak of the liquidity cycle we put about the end of Q3 2025. So, in the following 6-9 months, I mean, we've basically started to see markets kind of tread water at best, but they're finding it tough going. And what you're also seeing is the sort of key word is rotation. I mean, it's fair to say that the US Fed is not operating a monetary policy that is conducive for a continuing strong bull market. It's not operating a monetary policy yet that is consistent with a bear market, but probably, we've said at best what you're likely to see, at best, I would stress, is a sideways ranging market this year that could drift lower. If they start to tighten policy, or there's a much stronger real economy than we expect, which sucks up liquidity. So if you want to understand what's happening to gold, don't look at gold in dollar terms, look at gold in yuan terms, renminbi terms. And I think this chart has 40,000 easily written on it.
Most people think the market is still running fine. Tech stocks had a massive run. The US economy looked strong. Everyone seemed comfortable. However, appearances can be deceiving. But beneath all of that, something critical had already changed, and most people haven't noticed yet. The crucial flow of money driving markets for the past 3 years has already peaked and is slowing. Michael Howell, the founder of CrossBorder Capital, has one core message right now. The liquidity cycle that powered markets for the last 3 years has already peaked. The money is slowing down, and everything you're about to see in markets, the rotation, the flat indexes, the gold surge, is not random. It's a cycle that has repeated every 65 months for decades. And right now, we are in the downswing. He's not guessing. He's not speculating. He says the data clearly shows it, and the pattern is moving like clockwork.
Well, I think what we're seeing is actually the unfolding of a pretty normal cycle. When we last spoke, liquidity was sort of coming up towards a peak. That peak seems to have now been established. It's passed. We're starting to see a decline in the rate of growth of liquidity globally. So that's really referring to the flow of money through world financial markets. It's not that it's falling. It's much more the fact that it's slowing down. I mean, that's really the key thing. The markets tend to price at the margins. So these fluctuations in growth or slowing of growth tend to be really important. And I think that's what we're seeing. If you look at a lot of the major indexes, they're flatlining to down really since late last year. The actual peak of the liquidity cycle we put about the end of Q3 2025. So, in the following 6-9 months, I mean, we've basically started to see markets kind of tread water at best, but they're finding it tough going. And what you're also seeing is the sort of key word is rotation. We're seeing very clear rotation out of initial leaders in the market, like technology, towards later cycle areas like energy, commodities. I mean, they've really been the stars over recent months.
Michael Howell tracks something most investors completely ignore: flow of money through global financial markets. And what he's found after decades of data is that this flow of money moves in a very consistent cycle, historically about 65 months from peak to trough and back again. This timing has repeated in past cycles. He says the last liquidity cycle peaked at the end of Q3 2025, marking the current high point before a downswing. That means we are now in the downswing. Not a crash, not a collapse, but there has been a clear, measurable slowdown in the money-driving asset prices higher. And here's the thing that should worry you. Markets don't wait for the slowdown to be obvious. They price it the moment the growth rate starts to drop, which is exactly what's been happening since late last year.
In actual fact, it's a sort of a textbook cycle, if there is such a thing. I mean, we normally think of the liquidity cycle as sort of spanning about 5 to 6 years. And in actual fact, it's precisely 65 months is what we found historically by analyzing the data empirically. And this has been what seems to be an absolutely normal bang-on cycle for that length. And in actual fact, the last two have been absolutely on track in terms of that timing. And if you look at, you say, is this a sort of a standard or normal cycle? I mean, the answer is yes, in many ways, actually more so than any other, curiously. The way that sector performance has unfolded, the way that asset class performance has unfolded is very much in line with what we would sort of theoretically expect. In fact, much, much more so than maybe earlier cycles. So this one is absolutely moving like clockwork in a very predictable way. And what we should be seeing now is sort of signs that bond markets are beginning to get a bid. We should be seeing signs that investors are moving towards the safety of sort of safe haven assets. That would ultimately include the dollar, but the dollar not yet. You're certainly seeing performance from maybe mid to later duration bonds beginning to pick up unusually, because that's been the asset class that everyone is saying is the worst one possible and everyone ought to dump. But actually the performance has been pretty good of late. And obviously things like gold, precious metals have really been outstanding performers recently.
What makes Howell's warning harder to dismiss is that this cycle isn't acting weird or unpredictable. It's acting perfectly normal. The last cycle peaked in 2021, bottomed in October 2022, and the current one follows that template. Sector rotation and asset performance have matched past patterns. Technology led the upswing. Financials followed. And now, energy and commodities are taking over as the late cycle leaders. That kind of precision should make you pay attention. If the pattern holds, what comes after commodities is a risk-off phase: defensive stocks, bonds, and cash. According to him, that's where we are heading next.
The first thing to say is you've got to sort of envision two separate circuits of liquidity, one which travels through financial markets, which is really the initial one, and then the second one where liquidity spills over into the real economy. And the point is that all money that's anywhere, must be somewhere. So if it's in the financial sector, it's not in the real economy. And similarly, if it's in the real economy, it's not in financial markets. So what we're starting to see now is not so much that central banks are tightening. I mean, there's been one or two examples like the Bank of Japan or the Reserve Bank of Australia that have lifted interest rates. But it's much more the fact that liquidity is now starting to shift from the financial sector increasingly into the real economy to feed what is probably a rapidly expanding world real economy. And that's what the evidence is very clearly showing. So it's not the fact that policymakers are putting their foot on the brake yet. I mean, that will probably come at some stage in the next 12, 18 months, because inflation pressures will undoubtedly start to pick up. That will cause skittishness among policymakers. They'll start to raise interest rates, they'll tighten liquidity conditions, etc. But that is down the road. What's happening right now is that liquidity is slowing down in financial markets simply because the real economy is starting to accelerate, and that's dragging liquidity out. So that's the reason that you're getting this shift. And consequently, that's underpinning late cycle areas of investment like commodities that clearly get a lot of their bid from a stronger economy. That's one of the details that you would expect. And, you can see very clearly in the US market with not only working capital demands increasing, but also demands for more capex, particularly in the AI sector. It's actually forcing a lot of those formerly cash-rich AI companies or tech companies to actually pare down their treasury balances where they've been keeping a lot of their cash, take it out of financial markets to actually spend on new AI. Not only that, but they're actually coming to the market now and they're actually seeking to raise capital. So that particular process is directly taking money out of financial markets to spend in the real economy. But it's not just the private sector that's doing that. I mean, also it's one of the intentions of the US Treasury to actually make that move as well.
Here's what most people get wrong about this slowdown. They assume it's central banks pulling back. The Fed is raising rates. QT kicking in. Howell says that's not what's driving this. Not yet. What's actually happening is that the real economy is accelerating so fast that it's pulling liquidity away from financial markets on its own. Businesses need working capital. AI companies are spending billions on infrastructure. Capex is replacing buybacks. Every dollar going into building something real is a dollar leaving the financial system. That's the mechanism. It's not policy, not the Fed. It's simply a world economy hungry for cash, as it hasn't been in years.
If you look at the long-term picture, it's very unusual for geopolitical episodes like this to have a serious impact on the liquidity cycle. The liquidity cycle tends to be much more of a super tanker that sort of takes months or years to actually change direction. So you tend to see, as I said, 5 to 6 year cycles, and geopolitical events tend to be random, but they tend to be much shorter term. So they can have a big impact short term on sentiment, investor sentiment. There's no question about that. But they tend not to change the ultimate direction of liquidity, except if they do. And there are occasions. I think back to what happened in the in the late the late 1980s, early 90s, with the fall of the Berlin Wall and the events around the fall of communism. I mean, that was something that did change liquidity conditions, fairly significantly. But generally speaking, it tends to be a rare event, and this doesn't seem to have although as bad as this particular conflict sounds at the moment, it really hasn't got the impetus to change the direction of global liquidity as we speak. It's not to denounce or to belittle the importance of Iran, because if Iran came back into the world economy, I think it would be significant both for the world economy and for the Iranian people. But the fact is that in terms of the big picture, China and Eastern Europe tend to be a lot more important in the world economy.
The obvious question when you hear all of this is, what about the conflict in Iran and Israel? Surely that changes things. Howell's answer is blunt. Geopolitical events almost never change the direction of the liquidity cycle. The cycle moves like a supertanker. It takes months, sometimes years, to shift course. A conflict, no matter how serious it looks on the news, tends to be short-term noise. It can shake sentiment hard for a few weeks, but it doesn't rewire global flows of money.
Yeah, I mean, it's fair to say that the US Fed is not operating a monetary policy that is conducive for a continuing strong bull market. It's not operating a monetary policy yet that is consistent with a bear market, but probably, we've said at best what you're likely to see, at best, I would stress, is a sideways ranging market this year that could drift lower. If they start to tighten policy, or there's a much stronger real economy than we expect, which sucks up liquidity, then you're going to get a more pronounced drop in the market. But at the moment, it's being underpinned as best they can by liquidity. And I think you can see that the Fed is not in any hurry to tighten, because the tensions that we saw at the end of last year in the repo markets that were caused, should I say, by a relatively small drain of liquidity out of money markets of about 200 billion. That caused some big spikes. I mean, I can evidence the spikes here. Whoops. Here. This is what happened in the repo markets, which is looking at the SOFR interest on overnight reserve balance spread. So in other words, you can think of that as market rates being SOFR, market rates in the repo market, minus, let's say, Fed funds for simplicity. That spread, which spiked up at the end of 2025, basically was triggered by a shortfall of about 200 billion in the money markets, which arose for technical reasons, largely because the Treasury General account was very suddenly jumped. Now, the Federal Reserve could have allowed that. They said initially at the time that they weren't concerned about the drop in bank reserves and they were going to let it sort of feed through. They balked and they changed their policy pretty quickly. They introduced a new QE measure, although they denied the fact it was QE, although that's clearly nonsensical. It's just semantics. They said that they were operating a new policy called Reserve Management Purchases, RMP, and that has basically done wonders in recent weeks for actually repairing the repo markets. I mean, there's a little bit of a pickup lately, but generally speaking, repo spreads are sort of back into or close to a normal zone again. And that's reassuring. I mean, we've got to watch this clearly for sure, because the more that liquidity tightens, the more that spread will jump. And that's clearly something that could disrupt the bond markets.
To reinforce this point, Howell is clear about the impact, or lack thereof, of geopolitics. He explains that the Fed is not running a policy that supports a continued bull market, nor is it creating a full-blown bear market. What you get instead is something arguably more frustrating: a sideways market, one that grinds flat, drifts a little lower, offers no clear direction, unless two things happen. If the Fed starts actively tightening, the drop gets more pronounced. Or if the real economy grows even faster than expected and sucks up even more liquidity from financial markets, same result, a sharper fall. For now, the market is being held up by whatever liquidity remains. However, that support is getting thinner as conditions evolve.
As you start to see liquidity shrinking, so you see investors reversing that trade. They tend to be concerned about systemic risks. They think that default risks in the financial system will be greater in a tighter liquidity environment. That's a reasonable assumption. And therefore, they start to get out of risk assets and they go for government bonds. And those government bonds, bond prices rise. Their term premia tend to be bid down. Therefore, you would expect to see, as I say, a very close correlation between term premia and the liquidity cycle. And lo and behold, you see it. Those are two completely independent sets of data. One is a rate from the term structure, which is the black line, and the other is a rate of growth, which is taken from liquidity data, quantitative data. But they seem to line up pretty well. And what this is showing is as the rate of growth of liquidity deteriorates, as we're seeing now, so term premia tend to drop. And that's exactly what you're seeing. So in other words, there's an increasing demand for safe assets. So this is just the asset allocation cycle unfolding. And this is why basically you're seeing a situation whereby bonds are remarkably stable. And in fact, despite all the nonsense that's written by, particularly by the media, about bond markets being a sort of atrocious investment, the fact is that in the last 9 months, bonds have been not bad. In actual fact, the term premium across many bond markets has been, unbelievably stable. And this is, as I say, the cycle unfolding. So what we're seeing is not the great debasement trade. We're seeing rather the opposite, ironically. We're actually seeing monetary conditions tightening, which is why investors are going back to bonds. And the simple fact is that if we were seeing, a general monetary debasement, bond markets would be selling off, and they simply aren't.
This is the part of Howell's analysis that most people completely miss, even as they search for other explanations. Everyone keeps explaining gold's rise as a Western debasement story. Governments are printing money, inflation fears, currencies are being debased, investors are fleeing to safety. Howell says that's wrong. If that were true, bond markets would be selling off hard, yields would be spiking, Western currencies would be collapsing, but none of that is happening.
Well, I think the one message is just to look at one final chart, which is what's happening in China. You've got to understand, this chart. This is what China is doing. So I identified earlier on the fact that the Chinese liquidity cycle is out of step with America's. The Chinese liquidity is expanding. This chart here is looking at net liquidity injections into Chinese money markets, on a daily basis, which is why there's so much noise in that data. And what it's actually showing is the year-on-year increase in that liquidity. So what you're seeing is a general uptrend in liquidity injections, which have accelerated noticeably from the beginning of 2025. And why is that important? Because this is China trying to get out of its debt problems and, if you like, devalue the yuan internally against real assets. One of the corollaries of that is that the gold price goes up. So if you want to understand what's happening to gold, don't look at gold in dollar terms, look at gold in yuan terms, renminbi terms. And I think this chart has 40,000 easily written on it. And those little corridors are basically illustrating where you get, targeting by the Chinese authorities. But they want gold to go up. And I think the whole architecture of the international financial system is changing, with gold being a very important backing ultimately for the Chinese currency. And this chart is one that people very often cite as to say what is happening in the gold market, and the fact that real interest rates shown in black have lost their mojo, if you like, in terms of driving the gold market. And you can see the big disconnect that I've highlighted there between gold and real interest rates. That is what people talk about as the great debasement. It ain't a great debasement, it's a Chinese debasement. And if you look at this chart, this is showing the previous data on PBOC, China's People's Bank's liquidity injections in black against the gold price in dollars. And you can see that those charts seem to be spelling out the message that this is all about China. And not only Chinese residents are buying gold to protect themselves against monetary inflation, but the Chinese state is buying gold to back its currency.
The global financial architecture is shifting. Now, the liquidity that drove markets for 3 years is flowing somewhere else. The cycle that rewarded tech and growth is rotating toward commodities, energy, and hard assets. The Fed is trapped. It can't shrink its balance sheet without breaking the repo market. It can't ignore inflation pressure forever. And it can't support financial markets the way it did while the real economy is this hungry for cash. Meanwhile, quietly in the background, China is rewriting the rules of how gold is priced and what backs a currency. Michael Howell says the blueprint is clear. The pattern is on track. Are you prepared for the next phase, Or will you realize it only after it's already unfolded? Thanks for watching. Please don't forget to like and subscribe. See you next time.